All right, good afternoon, everyone, and welcome to today's webinar on the Kehrer Bielan Annual Industry Checkup. My name is Tim Kehrer. I'm with Kehrer Bielan. We're happy to be hosting today's event. We're going to wait for just a few minutes to start the discussion while a few more people sign on. While we do that, I'll go ahead and let you know how you all in the audience can join today's conversation. We've given you a couple of ways to do that. One is by clicking the raise hand button at the bottom of your screen. That'll allow me to bring you into today's panel. You can show up on the screen if you're set up to do video, or you can join us using audio only. That's really the best way if you have a question or a comment to join us, is by using that raise hand function. You can also send us questions or comments through the chat function. That's also a button at the bottom of your screen. I'll be keeping an eye on the chat box, as will the other members of our panel today, so that we can get to those questions as they fit into the discussion. It does look like folks are signing in quickly now. So I'm going to go ahead and introduce us and get started. Once again, welcome to today's webinar on the Annual Industry Checkup. My name is Tim Kehrer. I'm with Kehrer Bielan Research and Consulting. We're happy to be hosting today's event. What we're doing today, wouldn't be possible without the support of our sponsors. I'd like to thank them now. Our sponsors are CUNA Brokerage Services and CUSO Financial Sorrento Pacific. Thanks to you both. And we also want to thank our friends at Salmons for helping to make today possible. As I mentioned a little earlier, we have set up today's event as we do all of our virtual conversations to leave plenty of room for you in the audience to join the conversation. You have two ways to do that. You can click the raise hand button. That'll allow you to join today's panel, ask your question, have any back and forth that you'd like to have. You can also send us your questions and comments through the chat function. We'll do our best to keep an eye on that throughout today's event and get to your questions as we can. We've all done, a lot of virtual events at this point, I think, and a lot of us are looking forward to the day when maybe we can get back to seeing one another in a person rather than over Zoom. But the upside is that we have a lot of practice at doing this, and we think that we've come up with a model that works pretty well to try to recreate the kind of conversation and sharing that happens at our in-person study groups. The way that we do that is we've invited just a few people who will be on your screen throughout today's event. They are Rob Comfort from CUNA Brokerage Services and Jim Camapone from CUSO Financial. Both are veterans of the industry and will have a lot to share today. In addition to myself, we have a couple of other members of the Kehrer Bielan team with us. Our principals, Ken Kehrer and Peter Bielan, and the newest member of the Kehrer Bielan team, Steve Lipker. So we'll do our best to keep the conversation going today. But again, the door is open for you to jump in and participate. And I think you'll get a lot more out of today's event if you do so. So thanks for joining, and I'm going to dive right in to today's topic, which is the 2021 edition of the Kehrer Bielan Annual Industry Checkup. We've been producing the checkup since 2012. It is the only publication of its kind that looks at the health of the bank, insurance, and securities community from the broadest possible view. The report is available for free download on our website. I put the link there. I'm sure that that Google can get you there as well if you're not getting our regular emails. The data for this year's report covers over 2,000 banks and credit unions that are in the business that collectively employ 8,850 advisors. Some of the sources of data that go into what we're going to cover today are our annual TPM survey that covers the third-party broker-dealers that support in investment services in banks and credit unions, as well as our survey of the bank-owned broker-dealers. And finally, our research of the FDIC and NCUA filings. One question that we always try to answer in the checkup is how many banks and credit unions offer in investment services. This is maybe a trickier question to answer than you might realize. The FDIC reports that there are shy of 1,300, 1,270 banks with positive in investment services income. On the other hand, we know that that data is spotty. We know that it does not reflect the total number of banks that are in the business. Our own estimate is that there are 1,872 banks that are in the business. 40 of those are banks that own their broker-dealer. They tend to be relatively large banks. And there are another 1,830 banks that work with the third-party broker-dealers, as well as over 1,000 credit unions. So in total, we estimate that there are just over 2,900 financial institutions in the business today. We can look at the trend in how many banks and credit unions are in the business. We're going to start off by looking at banks. One trend to understand at the offset here is that the number of banks in the United States has been shrinking for a long time. At the same time, the number of banks that offer in investment services has also been shrinking. In some years, the number of banks in the business has gone down faster than the total number of banks in the country. In other years, it's shrunk at a slower pace. The light blue bars on this chart that you're looking at now are the number of banks that offer in investment services. You can see that those have been going down steadily for the past decade plus, right? And that charts relatively closely, again, to the shrinkage in the number of total banks in the country. But there has been some fluctuation in the share of banks that offer in investment services, and that's that green line on the chart. You can see that a decade ago, right around 25% of banks were in the business. That increased steadily over the course of the next several years. It hit a high watermark in 2017 when 27.5% of banks were in the business. But since then, we've seen somewhat of a shift in this trend where fewer banks offer investment services relative to the total number of banks in the country than they did previously. So that slipped from 27 to 2018, from 27.5% to 25.5%. And it sort of leveled off there, if you will. Went down slightly 2018 to 2019 and up a little bit again the next year. But right now, essentially the same number of banks are in the business, or the same share of banks are in the business than were 10, 12 years ago. So not a whole lot of progress on that front. Now, we can do the same exercise looking at credit unions. Sorry.
And before you do that, yeah, you might point out that even though there are fewer banks offering investment services today than there were a decade ago, a lot fewer. They're bigger. And in fact, the share of banks that of total deposits in the country, for example, of the banks that are selling investments today is much higher than it used to be. I think it's approaching 80%, I believe, of all of the banks that actually offer investments control 80% of the consumer deposits in the country.
Thank you, Ken. And yes, there is more detail on that topic in the study that that you can find on our website. So we can we can do the same exercise looking at credit unions, and a somewhat different picture emerges. Just like with banks, the total number of credit unions in the country has been shrinking. It's been keeping pace with banks more or less. On the other hand, the number of credit unions that offer investment services has been increasing slowly, but when set against the context of the shrinkage in the number of U.S. credit unions, you see that the share of credit unions in the business has been rising steadily. 10 years ago, 12% of credit unions offered in investment services. In 2020, you see that just over 20% are now in the business. It's the first time that we've seen this metric crest 20% since we started studying this. Now, we have a couple of people with us today that might have one or two things to say about this. Jim, your broker-dealer works, I believe the bulk of your institution clients are credit unions. And Rob, your broker-dealer works exclusively with credit unions. So what do you guys think? Why are more credit unions jumping into this business while banks maybe seem to be getting out of it to some extent?
Let my good friend Jim go first here.
Well, thank you, Rob. I think observationally, Tim, if you think a little bit about, the charter for a credit union, right? It's established to really serve the needs of the members. And, unquestionably, right, having investment solutions, financial planning, financial well-being, right, retirement readiness, these are all critical elements to really anybody's experience. So I think, from our experience, we're seeing a number of credit unions that are looking to get into the channel because they haven't been there before and want to be able to respond to the needs of their members. I have a couple of instances where recently we've had conversations with credit unions who said, we did a survey of our membership, and this was an area that was identified that we wanted to make sure we fill that gap. So I think that's, potentially one of the reasons why we continue to see some growth in this space. But Rob, I'd love to hear your thoughts on this as well.
Yeah, Jim, I totally agree. I mean, I think credit unions, I always think of credit unions as being in this business 15 to 20 years behind banks. So there is some catching up going on here, but I think Jim is right. And I think, Tim and Ken and Peter, you all did a survey based on the Macro Monitor where I think over like 52 or 53% of credit union members said they would prefer to have their wealth management needs met through the credit union. And so I think Jim's right. We're seeing surveys like that. And I think credit unions are also in that same survey. I think 40% of the members said the most important need was planning for their retirement. So I think credit unions are saying, hey, if we're really mission oriented, like we say, these are needs that we have to meet. And so I think that's another reason credit unions are beginning to jump in. They're under the same pressure for fee income that banks are under. And I think in the long term, we're excited. I think this percentage could go way up because I think we can serve credit unions virtually. And I think the last 12 months have demonstrated that we can serve clients virtually. So, we've got a real big burden to take those credit unions that are probably never going to justify a full-time advisor, but still serve those members with advisors on a virtual basis. So my hope is that percentage can definitely increase significantly through that virtual hybrid type approach.
Yeah, and on the other hand, I think there are barriers to get much further penetration in banks. I think that as I talk to people whose job it is to call on banks and talk to them to get into the business, they say they still find disintermediation resistance, concern about deposits being bled off into investments as opposed to the deposits they need to make loans out of. And something we don't hear at all anymore in larger banks or in publicly held banks. I think part of the problem with these smaller banks, they're individually owned, they're not public companies, they're really more insulated from a lot of the market forces that have forced other banks, public banks, to get into this business. And they don't have access to the same capital markets to get additional funding for their loan growth that larger banks have. So I think there are I'm not sanguine about much better penetration of the banking sector.
All right, thanks everybody. Great thoughts on that. Moving along, one other metric that we track through the annual checkup is average advisor productivity. That is gross revenue per rep. And just like we have over the, rather we're sort of shifting gears here, rather than comparing banks and credit unions as we've done on the past couple of slides. Here we're comparing banks that own their broker-dealer and the banks and credit unions that work with the third-party broker-dealers like CUSO and CUNA. If we sort of look at the kind of the overall trend here, right, you can see the light blue bars are average productivity in those bank broker-dealers. And you can see that, for the good part of a decade, productivity was on the rise fairly steadily year to year. And as we've looked at previously and we've discussed previously, those gains in productivity have really been the underpinning of the top line revenue growth that we've seen in the space. But starting a couple of years ago, you can see that productivity, those productivity gains, may have slowed down. Productivity looks like it may have plateaued. And that's certainly the case, again, in those light blue bars in the bank broker dealers. The dark blue bars are the third-party broker dealers. You can see that, again, in terms of long-term trend, it's kind of a similar story. Productivity was on the rise from 2008 to 2018, more or less. In the third-party broker dealers, there may have been sort of this little hump in 2013. But again, over the past couple of years, right, we see productivity in those firms being pretty much flat year to year. But one thing that remains constant throughout this time period that we're looking at here is the gap between the light blue bars and the dark blue bars. That is to say that advisors in the bank broker dealers appear to be more productive, and they appear to have been so, and they appear to remain more productive. Rob, you used to run one of those bank broker dealers, and now you're with a third-party broker dealer. But what do you think is driving this gap in productivity? Are the advisors that work in the bank broker dealers just that much better?
Yeah, this is an interesting stat, Tim. So let me address that question and maybe give you a thought on why productivity is plateauing. when you think about running a bank broker dealer, you have direct control of those advisors, right? They work for the bank, for the broker dealer, and your ability to influence their activity plans, to influence their success, the support level from the institution. You're in direct control of that when you're running a bank broker dealer. But when you're in a third party, now you're talking not about controlling one institution, but you're talking about trying to influence hundreds of institutions. And I use that word. There's a difference between direct control in a bank broker dealer and having to influence hundreds of institutions in a TPM. And I think that's the reason for the gap, right? You've got, in the case of Jim, in the case of ourselves, in the case of Cetera, LPL, all of us, we're trying to influence advisors in hundreds of different institutions. Many times they're not even our employees, right? And so we try to give them everything they need to be successful, both at the credit union level and or the bank level or at the advisor level. But there's a difference between trying to influence and controlling. I think that's a piece of it. The other thing I would say with plateauing, I do think that's a very interesting trend. And I would attribute that to just advisors, the typical problem we see in banks and credit unions. Advisors build up a big book of business. The book's way too big. And we all know that when you get to a certain point with your book, it becomes detrimental to your production for being so big. And you're talking about 1,000 clients, and how do you really do that? So I think there's going to have to be some real serious work to help advisors build teams, segment their books, etc., in order to really see these production numbers increase. The only other thing I would say is we look at our credit unions and banks, and we only deal with credit unions, but I think all the TPMs look at it this way. You can either have managed advisors or advisors that are employed by the credit unions and banks. We see a big difference in the productivity of advisors that are managed, in other words, employed by the third-party broker dealer, as compared to those that are employed by the credit unions. Now, there's some large credit unions that have very successful advisor productivity numbers, but I would say when the advisors are more in our control, then we see much higher productivity numbers than when they're not in our control. So there's just another perspective on it.
And Rob, I think your point about book size also plays in terms of the gap, because it turns out that advisors who are in a bank-owned broker-dealer setting tend to have much smaller books than the advisors
Right.
who are affiliated with the third-party broker-dealers. So I think it cuts both ways. It influences the plateau for everybody, but also it certainly influences the gap.
Yeah.
And then, Ken, to build on that, I think one of the differences here is that the bank broker dealer advisors got out ahead on the managed money assets.
Mm-hmm.
And on average, the advisor in the bank BD has a greater portion of their business or greater absolute dollars in a managed product, to where that revenue is moving them up the chart faster than an advisor that hasn't. Now, in recent years, that gap, I think, is starting to close, and especially in credit unions on a percentage basis, it's closing. But there were some years there where the larger bank programs really made some strides to help that productivity that's still showing up today. So another reason for managed business as a driver of your firm's success.
Mm-hmm. Well, we're not giving Jim a chance to talk. Go ahead, Jim.
I mean, these are all, great commentaries, and I really agree, right? I mean, in the, with respect to the plateau, right, we have capacity issues. I think that becomes apparent, right? Advisors are just managing, very large numbers of relationships. So, that I think really reflects, some of the flattening. And to your point, Ken, right? It seems counterintuitive, but less is more often, right, in our industry, and being able to have smaller books of business can ultimately drive greater productivity. And to Rob's point, right? I mean, there's such a difference in the financial objectives of every financial institution, right? It varies so greatly. And when you're talking about, roughly, right, 40 bank-owned broker-dealers in the study here versus 2,000 financial institutions, right? Those 2,000 are just going to be much different in what their objectives are, and really what the varying levels of integration will be with investment services as a line of business. So I think there's a lot more variables that probably play into it, and a much broader, spectrum of institutions than when you're kind of looking at that focused 40 that are well established, right? Have a consistent process for how they do that business. They have a uniform process, right? They have a very disciplined approach, to how they have the delivery model. And to Rob's point, we try to bring to the table best practices. We try to bring to the table those ideas and strategies that are impactful and get results, but they're engaged, at different levels. So it's a little bit of a mixed comparison.
Yeah, and Tim and I have looked at a couple of other potential reasons for this gap. One is advisor teams. Last year in a study that we did, we found that teams might be the most effective way to increase penetration of your customer base. And it turns out that the bank broker dealers are pretty far ahead of other banks and credit unions in putting their advisors in teams. That might be something that one can do if you're a bank or credit union working with a third party to boost your productivity. Start organizing teams. And then another factor is tenure. We find that tenure advisors with tenure just have more. An advisor with twice as much tenure has a lot more production than an advisor with less tenure. But the work we've done on that is counterintuitive, because it appears that the large bank broker dealers have higher attrition rates than the smaller banks and credit unions who work with third parties. So that that argument doesn't wash. And the other factor might be the fact that some of these large bank broker dealers are in the recruiting bonus game and are bringing in advisors who are already big producers and bringing clients with them, hopefully. And that might be another reason why the gap is sustained. Whereas I don't know how many of your credit unions and banks, Rob and Jim, actually pay large amounts of recruiting bonuses or not. But generally, that seems not to be the case.
Ken, an interesting thought would be if you were to take the 50 largest banks and credit unions that are with TPMs, so kind of equate that to the 40 large banks with their own broker dealer. Just take the top 50 with the TPMs, banks and credit unions. You're going to find that most of them are incredibly successful, have very high productivity metrics, but then, like you say, Jim says, we're talking about a universe of 2,000 here. Right. And that's where this disparity of commitment and support can really come across and affect the numbers.
Yeah. And so what you're saying is maybe size does matter, right? And that'd be another way of looking at it, especially as we're getting, that we'll talk about more later, some big banks moving across to begin outsourcing their broker dealers to a third party. We may have to start looking at this more as a basis of size rather than who is the broker dealer, right? Good insight.
Yeah, very good. And I'll, Ken, thanks for all of those factors that you listed that may help to drive what we're seeing in the chart here. I'm going to kind of add one more by way of segue to our next topic. It used to be when we would put the productivity chart up, right? One question was, well, what role do the presence of licensed bankers have to do with driving the higher productivity, right? The prevalence of licensed bankers was much higher in the bank broker dealers. Perhaps that's part of the reason why their advisors were more productive. I've seen some hard data around the branches with a licensed staff member working in it produce higher quality referrals, right? So that you might speculate that might drive that gap in productivity. Well, the problem with that theory is that everyone is moving away from the practice of licensing branch staff, and the bank BDs much more so than the institutions that work with the third-party broker-dealers. Here's just one snapshot in time, looking at the change from 2019 to 2020. You can see that in that span of just 1 year, the bank broker-dealers licensed banker headcount in the bank broker-dealers dropped 14.6%. The year prior, headcount dropped 13.5%. So we've seen a severe reduction in the number of licensed bankers in the large banks. And at the same time, we've seen a trend, a couple of large banks with relatively large licensed banker programs have moved those programs to a refer-only model. That's also happened over the last few years. So there seems to be a significant movement away from this practice, particularly in the bank broker-dealers. But the same can be said among the institutions that work with the third-party broker-dealers as well. This is actually the third consecutive year that we've seen licensed banker headcount fall among both of these categories. So, you might look at this, as I mentioned, this is a snapshot in time. You might look at this and excuse it as the result of the COVID crisis, right? Branches are closed. Why would we be licensing branch staff? But again, this reaches back at least for the last 3 years. So the trend away from licensing branch staff really can't be explained by COVID alone. Any reactions to this from the group? Do we think that the reduction in the use of licensed bankers is maybe part of what's constraining our growth, or do we think that following the logic that that a lot of these banks have followed, that removing these folks from the branches doesn't cost much and protects the bank against potential headaches with appliance issues and so forth? Anybody have any thoughts?
Tim, a couple thoughts to share, because as we turn the clock back, right, I think it's fair to say in conversations that we've had with programs, looking at the licensed banker model, right, there's been this lens on the regulatory environment. Historically, a lot of the licensed bankers, in many cases, may have had a limited product set or may have had a limitation, right, on what they could provide and offer. So I think it brought in a concern, right, our ability to demonstrate under the Reg BI if that licensed individual is not fully equipped to provide solutions across the gamut, right? Do we feel comfortable with that? And I think that got brought into question, through the regulatory environment. And then, the obvious is productivity. Are we able to really begin to quantify the level of productivity associated with that particular position? In many cases, we would find that there'd be numerous number of licensed bankers, but maybe the productivity isn't where we want to be. So, perhaps we did a shift trend and use the term, licensed refer or super refer, right? Somebody in this position to really do a much better job in a discovery conversation, but not carry, right, the responsibility of making the product recommendation. I think the other area that to me is pretty interesting, and Rob, I'd like your look on this too, seeing a bit of an evolution of what we call the business development officer, really, which is somebody that has multiple responsibilities for business development within the financial institution. So they're out there working with maybe small business, and they're working with creating lending opportunities And to me, right, this is a really integral part and an interesting way to make sure that we're getting out to talking with, potential clients that maybe have more assets, maybe have more needs, right? If I'm a business owner, there might be a retirement plan, I may have more assets. So getting a little bit more of the boots on the ground in that client-facing role, I think is a really interesting concept. And perhaps, right, we'll see a little bit more of a migration towards that. But we are seeing, several of the programs we work with kind of taking that step into maybe what will be the evolution of that model to a business development officer.
Yeah, I would concur, Jim. I think we may see a shift toward the licensing of these business development folks out calling on business, and I think that's healthy. I think there's a real correlation between the lending side and the investment and wealth management side that can be very incremental. I think, having come from years of running, a lot of licensed bankers, I still love the concept in banks, but perhaps, there's a shift in how they're used to what Jim was saying. I will say that in credit unions, I pushed and pushed and pushed, and I finally came to the conclusion that credit unions are just different. And I love credit unions, but it's probably just not realistic in a credit union branch scenario to really look at a heavy LBE type program, just for a whole host of reasons. They're just very, very different. There are people in the branches wear a lot of different hats, and it's just really a capacity issue. So I've just come to the conclusion that in the credit union side, probably not realistic, just because of the many hats these folks wear out in the branches. But I do think the business development, both in credit unions and banks, is very intriguing.
And Tim, as you look at this, you can think of the licensed banker programs as being an early attempt to segment your customer base and have some less complex issues solved by a less expensive sales force. But in recent years, we've now seen a broadening of other ways to segment, whether it's by using junior advisors to handle smaller accounts or smaller relationships, or call center advisors, and even digital solutions. So I think we have a whole proliferation of things that are maybe taking oxygen away from the licensed banker concept in terms of filling that need.
Excellent point. Moving on, I'm going to walk us through a few slides now. We're going to kind of step away from the exercise of comparing the bank BDs with the banks and credit unions that work with the third-party TPMs for just a moment, and look instead at the industry as a whole. These are year-over-year change, 2019 to 2020, for the industry as a whole over four, I think what we would all agree is very key metrics, right? As you can see, gross revenue, top line gross revenue for the industry was essentially flat year to year, grew by 0.1%. On paper, it looks like advisor productivity went up a little bit by 0.4%, but we know that part of that was driven by the reduction in headcount. There was 0.1% fewer advisors working in banks and credit unions at the end of 2020 than there were at the beginning. Same amount of revenue spread over fewer heads helped to boost that productivity number a little bit. AUM in financial institutions increased less than 5%, 4.7%, which doesn't look so good when you consider that most of the major stock indices were up between 15 and 20%. Now, you could look at this, I think in a normal year, we would all look at this and say this is pretty disappointing, right? Now, 2020 wasn't a normal year. I don't have to explain that to anybody. And given everything that was going on, right, to the extent that it looks like the industry sort of treaded water last year. You know, maybe treading water is kind of the best that we could hope for. When you look at that, the fall off in headcount, for example, you know, there was a point in 2020 when I think banks appeared poised to shed a lot more advisors than they actually ended up doing. So perhaps this is kind of the best that we could have hoped for. Does anybody else want to put a different spin on this kind of glass half full or glass half empty, or do we think that that's about right?
Well, you know, Tim, I think, and there's a couple things, and where I'm going, you know, I know there's a couple more slides that you have around some of these metrics, and I thought there was some interesting studies. I don't want to get ahead of it, but I thought there was some, you know, some interesting findings in regard to maybe when you're looking at that number, the 4.7, which is the entire industry, you know, versus what you might have seen in the bank-owned broker-dealer versus the TPM space. Because really where my comments are going to go here, you know, a couple of things, right? One, we always have to take into account that, you know, not all of the assets that are invested in the investment services program are going to be, right, S&P 500, right, assets. There's going to be a large portion of that that are going to be allocated towards things like fixed annuities. So that's going to, you know, reduce what that overall growth rate would be. We also have to take consideration, you know, financial institutions are serving in a lot of cases, maybe older clients, and maybe a number of these clients might be more of a distribution phase than in a accumulation phase. And we've done a lot of studies kind of looking at that through age bands to get a real sense of, you know, what we can expect to see in terms of a runoff every year. And there's some really interesting findings there, right? You can assume, right, for qualified assets, people over the age of 70 and a half, and what they might be taking out. And I think, you know, the other aspect, if I look specifically to, you know, what we saw last year in terms of the environment, right, to your point, there was a lot of uncertainty. So I think those things all kind of play into it, but I'll let us go into the next couple of slides. I don't want to get too far out of it.
Yeah, no, great, Jim, and that was a great way to segue. So yeah, what we're going to do now is sort of peel back the data a little bit. Here we're looking at just revenue growth on this chart. You can see on the right-hand side that 0.1% growth rate for the industry as a whole. But you can see when we break out the institutions that work with the third-party broker-dealers from the bank-owned BDs, kind of a different story begins to emerge, right? Gross revenue was up 1.6% in the institutions that work with the third-party broker-dealers. It was down by just about half of a percent in the bank BDs. Now, those, you know, as we discussed a little bit earlier, right, the bank broker-dealers have the bulk of the advisors. They generate the bulk of the revenue. As a result, that they are going to skew that overall number, right? The industry average will always be closer to the bank BD than it would be to the TPM. But nonetheless, you know, this is a pretty big disparity, right, between the experience of these two types of firms last year. We can peel back the data a little further to try to figure out what's going on. Here we're looking at, again, the same 4 metrics that we looked at a couple of slides ago, but this is just for the bank broker dealers. You've seen on the previous slide that top line gross revenue was down 0.4%. Advisor productivity, again, kind of looks like it was up slightly, but that was aided to a large degree by the reduction in headcount. So headcount in the bank BDs was down 0.7% year to year. And again, AUA, I should say, was up 3.5%. So slower than the 5%, the 4.7%, right, that we saw for the industry as a whole. I want to call your attention to a couple of things here. First of which is that this is the 4th year in a row that advisor headcount has declined in the bank BDs. So this is a long run trend. Honestly, the reduction that we saw last year was less severe than years prior to. So again, the reduction in headcount doesn't appear to be related to the pandemic. This is something that's been going on. And to address a question that we got over the over chat from a couple of minutes ago, yes, it appears that the failure to add advisors, or in this case, the reduction of advisors, is absolutely putting a drag on top line revenue growth. We're going to look at these same 4 metrics now for the institutions that work with the third-party broker-dealers. As we saw a couple of slides ago, gross revenue for these firms was up 1.5%, 1.6%. You can see here that there was a modest increase in productivity coupled with a modest increase in headcount that together added up to a modest increase in top line gross. In terms of asset growth, you can see the institutions that work with the TPMs grew AUA by almost 9%. So that's 2.5 times greater asset growth than was realized in the bank broker dealers. So pretty significant discrepancy here. I'm going to put up this screen for a minute. This is just the same two charts that we just looked at, comparing bank broker dealers on the left with the TPM client institutions on the right. And you know, I want to ask the group, maybe Ken first. You know, why do you think it is that it looks like maybe it's been easier for the institutions that work with the third-party broker-dealers to grow the business compared to the bank-owned BDs?
My guess it's less resistance to recruiting and hiring advisors, but I'd be interested in what the others on the screen think. But clearly that's been the driver, right?
Yeah, certainly. You know, just you know, I mentioned a couple of slides ago, right, that this is the 4th consecutive year that headcount has gone down in the bank BDs. By comparison, headcount hasn't grown every one of those years in the TPMs, but growth has been much steadier.
Tim, I'd say that I always come back to headcount. My sales managers get sick of me saying it because I say it on every call. You know, the sign of a healthy firm is growing advisors, right? And I think, you know, one of the things that and I think the headcount issue contributes to all these metrics that are somewhat, you know, subpar. And although it was a really brutal year last year, right? It was a tough year and it was a weird year and all that went with it. But this is a continued trend of headcount, you know, not really growing. So I think we've got to get creative with headcount. So, you know, one of the things that we have roughly 300 credit unions that we work with, and they've been really receptive to growing advisors. But we're looking at growing advisors not just through recruiting, but through teaming. So we've created a number of positions by which people can come onto a team, not even coming in with their licenses, right? We're looking for high potential, less experienced people to come in on a team in various positions. It also gives us a chance to really address diversity and inclusion, because we're trying to tear the barriers down of entry into this business and give a whole new group of people that have never really had access to the business. because they don't bring a lot of AUM. They don't bring, a trailing 12 of 400,000, and they don't bring all the licenses, but they bring a lot of potential. And so we've worked really hard at that. And through that teaming, we've been able to add a lot of what we call associate financial advisors. And we've even created a big internship program. So our credit unions, the last couple of years, last year in 19 grew headcount 10. And in 2020, they grew headcount almost 7%. So that's really because of the teaming initiative that's enabled us to bring people in and develop them into advisors without depending on just recruiting.
Yeah, I would echo what Rob said. I mean, it is headcount. We know headcount is the biggest, best driver of incremental revenue. If there's a secondary one, and it would be second to headcount, I think if we looked at this in revenue per million as far as coverage, I believe the bank broker dealers have higher revenue per million than the firms that use TPM. So there might be some regression to the norm here, in that as the TPM firms get closer to the levels that the bank broker dealers have, they're showing, an annual gross revenue increase that's higher than the bank broker dealers. And, that was seen a little bit here earlier in the slides of the average production. So, maybe the TPM advisors are moving, closer to that 500 number easier than the bank broker dealer advisors are moving from 500 beyond.
And another factor might just be, particularly in the bank broker dealers, if you're not growing, you're not going to get the resources to grow. And with no growth for the last few years, it's difficult when you're sitting, if you have a seat at the money table, and many heads of the bank broker dealer don't have that seat yet, it's hard to get your share of a bigger share of the investment pie. And there are two kinds of investments. One is it's investments in people. It costs money to add advisors. It certainly depresses your margin in the short run to add advisors. And then there's the ever growing investments you have to make in technology to make your advisors more productive, attract and keep advisors who see the whiz bang technology the guys in the other firm are using, and so on. So I think that those two things are really constraining and have maybe been hurting the bank broker dealers more, because that's more of an issue there, I think. But you guys work with smaller institutions, so you have a better idea of whether that thought is off base or not. Certainly, I guess if you have managed programs, you're in more control of that growth yourself anyway, right?
Well, Ken, I'll just add that the statistics are interesting. And a number of our larger credit unions have aggressively added advisors, right? And through teaming, and their numbers in revenue, AUM, all their metrics are well above these averages because of that headcount growth. So I just keep coming back. To me, that's so critical, because it addresses that big book. Right now, you can build teams, you can segment the book, you can go deeper, you can have smaller territories. It all comes down to that metric.
And your point, as far as, a seat at the money table and the investment that's needed, I think that's absolutely one of the things driving this trend that we've seen very recently of some larger bank BDs transitioning to TPM models. And, it's probably multiple reasons, but, one of them certainly is, does the bank and has the bank made the needed investment? And if they haven't made the needed investment, it's probably come out in these last few years in the difficulty of that firm growing their business. And will they then make the needed investment? And, I think some firms are viewing that, saying they may not be able to make the needed investment to give their advisors a competitive enough platform to where they can grow the business. So I think, there's where we hadn't seen as much movement in that type of going from a BD to a TPM in the in the past few years. We've seen more of that recently, and I think the results are a reason. The investment needed to be in that business is a reason. Banks not wanting to assume risk is a reason, but I think much of it is a result of the business results over these last few years. Is that unfortunately we may not be the growth engine to banks that they had hoped we were going to be.
Sounds like we've frozen for a minute, Tim.
Yeah, Peter may have frozen on us there.
But I think the point was a good one. So.
Yeah.
Have I thought out yet? Have I thought out?
Thought out, yeah.
Good. Yeah, one, just turning back to the issue of headcount, Peter has said many times, right, that the most common question that a program manager or that a bank BD president gets when they want to add headcount is, when am I going to break even, right? When is the bank going to break even on this new hire? I'm curious to know, Jim and Rob, is that a reaction that you get when you're talking to institutions about adding headcount? And if so, how do you get past that, or does that not come up as often?
From my experience, Tim, again, it drives back to both what you and Peter are saying, right? The financial institutions all have different financial objectives and expectations, right? And when you're running your business in a model that you're trying to really, manage your strategy quarter to quarter, then that's going to be a lot different, right? Than when you're looking to play a longer game in terms of what your expectations are. So, when you start to look at, the pressures in publicly traded companies and the metrics they have to get to, perhaps versus where you may be in a credit union environment where they can put a little more emphasis on the long game, right? And a longer return. I think we can definitely make a case that, the long-term investment will pay off over time, but it's difficult, right, to get that consistency in the short term. So there's no question about it, right? When evaluating some of that, we have to make a business case. It's just a matter of what the appetite is, right? Is it accretive in 6 months, 12 months, 24 months, 30 months? What's the acceptable, level? And then what's that return on that investment going to be? I mean, obviously we have to achieve a return at some point, but it's really what's that period in time that we have to look at. And again, I think that spectrum is just so broad. Again, we're looking over 2,000 financial institutions, right? They're all going to have a different expectation of what that should be.
Yeah, we find it certainly easier, Jim. I think you probably do too, when the credit union is a managed credit union and the advisors are our employees and they're on, we're literally funding those new advisors. It's certainly easier to get them to optimize advisors, although, there's still office space and all the things you got to deal with there. What we have found is that credit unions, like banks, are, especially the larger ones, or even, I don't even know a size, are under the same FTE pressures that banks are under. And so getting FTE approvals, even for advisors, even though we don't think of advisors as typical FTE, right? They're revenue generators. What we've started doing is, if the advisors are employed by the credit union and the credit union can't seem to get the FTEs approved, and let's say the credit union has 7 advisors, but optimal is 14, but they can only get 1 FTE approved per year, we'll basically come in and say, hey, why don't you put them on our books? So now part of their advisors are employed by them, but the new advisors are employed by us. And we're perfectly fine with that because we know the numbers work, we know the math works. And they seem to be very receptive to that because that gets them to optimal numbers of advisors without having to keep fighting to get FTE approved. So it's just another thing that we're trying.
So I guess in the in the situations with M&T and with BMO, are those advisors essentially going to be off the books of the bank then? Peter, do you know?
I would think so. I believe they still have a choice if they want to be their own broker dealer or not. But I would believe those advisors would not be FTEs on the bank books, right?
Peter, I think they would be employed by the bank. They would still be employed by the bank. So they would still be on the bank's books, basically. They wouldn't from a regulatory standpoint, but they would, in the case of
Right.
M&T and BMO, they'd still be employed by the bank. So I think that would be technically still on the bank's books.
Okay.
That's my guess. Maybe someone else
Yeah.
would know that.
I know Pete Schmidt was supposed to be on the call, although they're converting this month, so he may not be out there. So if he is, let us know, Pete. Tim?
All right, great. I want to bring us back to that sort of broad industry view that we started off at with, when we started today. Here, this is an updated version of a chart we shared during our webinar last month. For those of you out there that tuned in, it may look familiar, but what we've been able to do since then is fill in the data for 2020. Just to sort of explain what you're looking at here, this is looking at three of the same metrics that we've been exploring throughout today's conversation. Top line gross revenue, which is the sort of thick blue line, advisor productivity, which is the thin bright blue line, and advisor headcount, which is the green line. We've indexed these three metrics to 2015, and we've applied the year-over-year change that we've measured in these metrics across each year, 2015 to 2020. You can see that in those first couple of years, the three metrics tracked very closely with one another, right? 2015 to 2016, there was sort of equal reduction in all three: revenue, productivity, headcount. 2016 to 2017, you can see how, again, a modest increase in productivity coupled with a modest increase in headcount led to a somewhat larger increase in top line gross. But starting in 2017, we see a very different story, right? Productivity went up and drove the corresponding increase in top line gross revenue, while headcount started to decline. 2018 to 2019, you can sort of play that story again, except that 2018 to 2019, productivity didn't go up enough to drive that increase in top line gross. So gross actually went down a little bit. 2019 to 2020, as we've just talked about today, revenue was flat, headcount fell off by a little bit, and it looks like productivity went up a little bit. That's kind of an aberration. What we focused on when we looked at this chart last month is that, it's pretty obvious that as an industry, we've been relying on increases in productivity to drive top line growth. We've failed by and large to add headcount to a degree that is helping to drive that growth. Now, we've spent a decent amount of time today talking about the plateauing of productivity and how that might not be something specific to the pandemic. It might be something that's here to stay. So how do we get back to growth? How, as an industry, do we get back on a path to growth? And I know Peter had some thoughts that he was going to share on that. So I'm gonna kick it over to Peter to start us off.
Okay, thanks for that, Tim. So I think there's two main things that we have to look at here. It's first of all, do you have the right resources deployed to support these initiatives And then how is the execution of these initiatives accomplished within your organization? So, we've spent a lot of time talking about the past, how it looks year over year, how we've gotten to the point where we're at, different models, different performance levels within those models. But when you're running your business, what are those things that can truly change the numbers that Ken and Tim have been going over? What can change the top line revenue, the net number of advisors, your asset number that you have? What can really change your year over year gross revenue, so that this is a growth engine for your bank or credit union going forward? And we listed here, I believe there's 16 different initiatives that firms can adopt, really, they have adopted really at different levels of implementation. And, as we look on this list, there's things that have been out there that we've talked about for years. There's some, for instance, managed assets that many firms have done an extremely great job on as far as having success with that. There's others that the desire has been there, but the results haven't followed. For example, insurance. Insurance for years has brought in, approximately 2% of revenue without much change. It hasn't gone the same path as managed assets. But all in, these tend to be 16 or so initiatives that we've seen firms implement in varying degrees. We've seen firms get the resources in place to utilize and to optimize these in various degrees, and the success from it. So I would start with this list as things that a firm should look at and say, where can I get the resources needed to, or the ones that you pick that really fit your business objective, that you think will be the most helpful to your business and that you can sell within the organization. Because, saying you want to do one over another isn't necessarily going to give you the results. The resources deployed to it, the execution that you all put towards it will give you the results. So firms can't pick all 16, but they need to decide and claim their stake to which ones they're going to get resources for, make investments in. And we believe if they do that, then their results will start to break out from the norm. Similar, you look at the total results that we saw here, and they hover, depending on what we look at, but let's say they hover, in a 1% range, 1% of annualized revenue. Well, not every firm came in at 1%. There were some firms that did noticeably better than 1%. There were other firms out there that we know that were down greater than 10%. So the average can be a little bit misleading. And it's because there are firms that have been able to get resources, and there are firms that have focused on some of these with greater success than others. And I'd really encourage you all to focus on the ones that you can get done and that will help your particular business get the most success. So Jim and Rob, you both have that unique position of having run programs and having to implement these directly within your organization. You've also now seen the business from, understanding, knowing many programs. And I wonder if you'd each comment on, where you've seen some success and where you feel firms would be best suited to put their chips behind in order to help, grow that revenue, asset, number of advisor initiatives that they're trying to make happen.
Yeah, so Rob, you want me to take a run at that?
You go, my friend.
Right. So, Peter, these are all great ideas. Without a doubt, right? And I won't focus on all of them. I'll pick out
Right.
2 or 3 and certainly, provide Rob some opportunity here. The financial planning focus, obviously, statistically, we know when there's a certain number of financial plans that are being done on a regular basis, it drives greater productivity, right? And it really serves to benefit the client, it serves to benefit the advisor, serves to benefit the organization. It's the opportunity to get deeper with existing clients, right? Have more meaningful relationships, and quite frankly, right, to build a process and a client experience around a tangible deliverable, which is really this process of providing the guidance and the roadmap to somebody. So it's not a product, a financial product solution, but it's really more around the client's experience and really addressing all of their needs. So just a huge believer in the impact of that. And look, it takes discipline and it takes, you know, some level of accountability and training and resources to do that. But I think we have countless examples of programs that embrace this and really have managed to increase, right, productivity to a much, much higher level. So, you know, that jumps out. You know, one thing I'll throw out here, you know, Peter, it's actually not on the list, but I think it warrants some conversation, is, you know, looking at what we're doing in terms of, you know, the digital strategy, and what are we doing in terms of data mining, and what are we doing in terms of trying to create opportunities, right? Because I think, you know, what we're really talking about here at the ground level is, how do we get advisors more opportunities to see more people? Because opportunities will drive everything, right? If I can create 300 new opportunities a year, that's another advisor. So we want to be able to continue to do that. And traditionally, I think, you know, the inflection point is we've been relying on our financial institution relationships to create those opportunities, and they're still there. But, you know, the way that we've tried to harvest them in the past has been through that referral network. And perhaps we need to step back and say, we have other tools and resources available to us to get a lot more specific about how we approach this. So I think in terms of, you know, thinking about how do we use data mining capabilities to identify opportunities within our own client bases, right? To identify the attributes of the investors we have today, and then get really specific about the types of messages that we want to send out there to either a specific situation, or quite frankly, right, to cultivate those leads through life stage messaging. So I think that's just a world of opportunity, and it incorporates, I think, soundly with a lot of the digital strategies of the financial institution. When you look at things like client journey mapping and what that experience needs to look like, and really a way to solidify the value of working with the financial institution and bring it all to a much, much different level, right? We have this, the whole reason we got into this business, because there's an untapped market of opportunities that have strong relationships with the financial institution. So I will tell you, Peter, it's a chip that, you know, we're going to probably put in the game here, you know,
Right.
take forward on, because, you know, we feel that's a real strong focus area. So.
Yeah, and Jim, that's a good point. You know, it's sourcing of this non-branch or external referrals that I think you mentioned, and it's very true. I mean, we've had the advantage of an industry that's been able to get referrals from a branch network for 30 years. And that's given us a start in this industry. It's given us a really good start. But now our industry has to evolve. And not that those completely go away, but they might change form, but we can't limit ourselves to that. We've got to find ways to data mine, to reach out, to proactively bring in clients and members that we can help with their financial needs. So it's given us a great head start, but now we need to really evolve our business to do more than that. And I think, you know, you're exactly right, is that each firm needs to look at however many clients they have today, how do they bring in that number again? You know, how do they double that number? And it probably won't be the same way that those first group came in. So good point on highlighting that one. Thank you.
I'm going to lob it to Rob, because there's a lot of those to talk about.
They're all good things. I'm going to focus on just a couple areas, though. You know, you look at optimizing territories, net advisor growth, and utilizing multiple advisor roles and teams. I really think, especially that utilizing multiple advisor roles and teams, until you really go after that, none of these other things are really going to be all that relevant, because you're not going to have advisors with the capacity to really do that. You know, obviously, I'm a big advocate of the planning focus and the whole industry transitioning to the planning focus and the managed money focus. But again, until we really grow advisors and optimize territories, and I believe especially through multiple advisor roles and teams, we're never really going to be able to get to where we want to get to. So I think that's critical. And I think looking forward, the omni-channel delivery, right? There's a lot of other ways that we can deliver. We're learning through this whole crazy lockdown that we can deliver in different ways. And I think, focusing on those omni-channel delivery methods is another piece to this growing of advisors. The ability to serve more members, the ability to go deeper with clients. I think the omni-channel is another part to that whole, what I would call multiple advisor roles, teams, growing advisors, et cetera. So those would be the areas I'd focus on.
Mhm. How about for the two of you, the whole technology discussion? We just mentioned that a minute ago, as far as, one of the reasons that some firms have considered moving from their own broker dealer is because of the technology need that they have to have in place that, they may not or may not be able to have in place in the future. What do you see as far as the importance of technology as far as staying in the business for the firms that you all service?
Yeah, there's no question around it, Peter. It starts with process, right? But process is really driven by, the ability to support that, and technology becomes, I think, the engine that drives that for us, right? It's the way that we can manage every aspect of our business model, right, day to day. And it's incredibly complex, right? And it changes so rapidly. Such a demand for information, such a demand for integration, right? We want everything at our fingertips. In the ideal world, right, I flip on the switch, I see everything I have to do today, and it automatically happens. So, automating workflows, automating strategies for things like lead development, lead cultivation, working those workflows right through, through the client account opening process, and then the management of the relationship. Right. And then on the back end, having the ability to extract all the reports that are necessary to be able to evaluate, right, the metrics of the program. And when you think about it, right, there are thousands and thousands and thousands of points of interface that need to go into that system to make it effective and impactful. So, from a single institution, that becomes more and more challenging because it consumes more and more resources. You're talking about, is there an opportunity to move from, being my own broker dealer and perhaps like looking at, utilizing the resources of another broker dealer, right, in order to provide that type of technology. So we're having a lot of those types of conversations today because it is a matter of economics, right? And so there are solutions that, can be provided. So you can maintain your brand, you can maintain your strategy, but still, right, be able to leverage the innovation, the technology, the best practices, and some of the other, pricing models that might be available to you. So I think it's incredibly important.
Okay. Along those lines, I looked at a piece of data the other day, and Morgan Stanley, who, our advisors compete in and really against in every one of our markets out there, from a technology standpoint, they have 10% of their top line revenue goes to technology expenditure. And that consumes 40% of their non-employee costs. And that number is $4 billion a year into technology. So, it's coming. It's here, it's coming, and it's just going to be, more critical that we have, what you described, Jim, as far as, from point to point and for things to work, because that's what our advisors are going to compete against, is technology of serious dollar levels that, that banks are going to have to find a way to compete with. Otherwise, their advisors are going to be at a disadvantage. and I think it blends right into this, investing in advisor development. Some of the best firms that we work with, we notice how much they really do invest in their advisors. And maybe Rob or Jim, you could comment on this, because in many cases, you're in that category, but we know firms that really do invest in the advisor development, because it isn't as much now. When we brought them in the years past, it was, you could teach them how to do that job within the branch network, and they could be an advisor and be successful. Now our advisors have to be, much more skilled than they were years ago, because of the competitive nature, because of the changing landscape, the additional products, the compliance responsibility, the competitive nature, all the different firms that are out there competing for that business. You have to be better. And the firms that are putting money towards, and resources towards, and skilled people towards advisor development seem to be the ones that, again, are winning this game of getting 10% growth when the industry is at 1% growth. So if either of you would comment on that one for the benefit of the group, because we do think that's a budding trend here that, lead firms are going to continue to take advantage of.
Sure. I mean, I'll share, Peter. I'm very blessed. We've got an incredible, we call it the Center for Advisor Excellence, and it's all about practice management, professional development of our advisors. And we have various academies, right, that advisors go through. And what we've noticed is that those investments pay off huge, not only in terms of AUM growth. We see 25% growth right off the bat when they graduate from the academies. We also see a retention level, like the appreciation level that their careers have been in. And these are academies that go for a year, right? Mm-hmm. And it's ongoing. And these are the kinds of academies where, when we partner, we have Canon Financial, and we have other partners that help us do this. But my point is that investment in their professional growth pays off huge, not only in growth of their business, the level of professionalism they execute the business with, but it also pays off in terms of their loyalty and retention of advisors as well. So I'm a big advocate of that.
Yeah. Rob, do you have any ways that you measure how an advisor performs once they achieve different levels of that academy, or the development that you give them?
We do, Peter. We look at a lot of different measurements, pre-academies and post-academies, and the numbers are pretty staggering. And it changes their vision of the business, right? It changes the way they view the business in many cases, gives them a real passion, it maybe an even deeper passion for the business. So yeah, we look at those metrics, and the payoff is huge. So investing the money to us is very worth it.
Excellent. Good. Thanks. Okay, Tim and Ken, I think we'll throw it back to you. Just my final comments on these are, if you're looking for where to put your efforts running your programs, this is a great list to start, and maybe the list to end with. But you've got to do something in these categories to really separate yourself from that industry average. And we're all trying to up the average. And the way we do that is by keep separating ourselves on the high end from the average. So thanks for the time here on the call, everyone. Tim, I'll send it back to you.
Tim, any
mute. Tim, you're on mute.
Oh. Hands.
There we go. Yeah, I was just about to ask the same thing. Any other closing thoughts? I know that one thing that we haven't talked about today that is a focus of the study that you can download from our website is that there's some indication in the consumer financial data that we study to suggest that the table is kind of set perhaps for the industry to grow in 2021. If you look back over the past several major cycles of economic downturn, one thing that we see in this data is that whenever there is a downturn, the share of households that need professional financial advice goes up, right? So when the market is good, when the economy is good, consumers feel self-empowered to handle it on their own, right? But when they're faced with a crisis, that's when they turn to advice from a professional financial advisor. We're seeing that the most recent batch of data that I have was collected during last summer, the summer of 2020, kind of the height of all this. And no doubt, US households are turning to advisors like never before. They need the advice. And as banks and credit unions, we enjoy high levels of trust among our customers and our members. And Rob cited something earlier, right? That credit union members, in particular, want to do all of the household's financial business through their credit union, and we see a similar trend among bank customer households as well. So, the table really may be set for 2021 to be a strong year.
But on the other hand, it looks like a lot of banks and credit unions aren't positioned to take advantage of that because they don't have enough advisors to take advantage of it. They haven't really transitioned those advisors to be planners as opposed to salespeople. And they, for one thing, they're not ready to sell insurance. I mean, again, that another thing in the consumer data that Tim has looked at is that for the first time in memory, maybe more people are saying, gee, it looks like I don't have enough life insurance. And it looks like it appears that banks and credit unions aren't positioned to get that business because what's their plan to get it, right? So again, a question of resources. This is a great list of things to do. It's going to take resources and execution, right, Peter?
That's right.
To make this work, and it's possible to get more at bats this year than last year, but you've got to take some of these steps to get those at bats.
Mm-hmm.
Can I just add on this quick? I know we're at the end of this, but just incredibly optimistic. I think about what the future holds. We're always responding to changes, right, and changing our environment. And I think looking at what we've gone through in the last 12 months, right, it's made us kind of step back and say, okay, we have so much opportunity in front of us. How do we get better at really pulling those levers? Rob, spot on, right? The investment in human capital, the development of our advisors, it's critical. Bringing more advisors into the game are critical. But, Tim, I saw a survey, less than 20% of individuals right now feel confident to manage their own financial future. So the opportunities are great, right? We have all the tools and resources in front of us. Technology becomes the driver to help us build these processes. So I think there's great opportunity. And, Peter and Ken, right, you have a list here. There's a lot of great things. So excited to move forward, and just want to say thanks for an opportunity to participate in the panel today.
Yeah, last word from me. Thanks, Jimmy. I'd say I'd be remiss if I didn't congratulate this industry. I look at how our credit unions pivoted last year in the middle of the pandemic and just did incredibly professional work, right? In serving their members. I have so much respect for our credit union partners, but I have great respect for this whole industry. And if go back a year ago, right? Put yourself back a year ago when you were sitting in those meetings with your finance people, and they were saying, "Well, what's the impact of this going to be?" And we were starting to speculate we might be down 50%, right? This could have been a disastrous year. But when you look at these numbers, we're not excited about the fact that advisors aren't growing. We're not excited about the fact that revenue was kind of flat. But look at what this industry had to overcome last year just to be flat. And I say congratulations, because I just think this is an industry on the bank and credit union side, the bank BD side, the TPM side, the credit unions. It's an incredible group of professionals. I, for one, can't wait to see everybody in person again. And I'm just grateful to be part of this great industry and these great people. So thanks, Tim, Ken, Peter, appreciate it. Jimmy, appreciate it.
Awesome, Rob.
All right. Well, I think that is a great note to end on. Thanks for that, Rob, and thanks for everybody else on the panel. Thanks also to our sponsors once again, CUNA Brokerage Services and CUSO Financial Services, Sorrento Pacific. And thanks also to our friends at Salmons for bringing us today's event. Thanks also to all of you in the audience. We had a lot of questions come in over the chat. I think we managed to address them through the flow of the conversation. Feel free to follow up with me or any of us if you have further questions. I hope you'll consider joining us for one of our future virtual dialogues. We have one coming up on April 13th around growing your ed advisor force, very apropos of what we talked about today. And we have a web event scheduled for May 13th as well around developing holistic advisors that focus on financial planning. Over the summer, we'll be gathering to review Peter's biannual survey of advisor compensation. We're also looking at holding virtual events on insurance and tech that Steve is going to be leading the effort on. So you'll be hearing more about that soon. And in the fall, we're feeling optimistic that we might be able to return to our normal schedule of in-person study groups. We'll hold one, as we always do, that's meant for the program leaders, one on integrating retail and wealth management services, another on developing holistic advisors, and finally one on managing omni-channel delivery. As I said, we're feeling pretty optimistic. There are actually dates for these on our website. So if you want to visit the website and pencil these in, please do so. Thanks again. I'm going to stop sharing my screen to make sure that we can see everybody as we sign off here. Thanks, everybody.
Thanks.
Okay.
Thank you.
Thank you all.
Good to see you, Rob.
Thanks, everybody.
Thanks, Ken.